Hi all. This week we're going to talk about how to use your super fund to save for your first home. As always, I can't provide personal advice specific to your circumstances, so what we'll share is generic and educational in nature, and we always encourage you to seek professional advice before making major financial decisions. So, this year, lockdowns have led to a significant reduction in the number of us, particularly millennials, eating smashed avo brunches and enjoying Friday night drinks. Unsurprisingly, most of us are not in a position still to buy a home. The reality is that saving for your first home can be tough. But it hasn't always been this difficult. So in the 80s, more than 60% of 25 to 34-year-olds owned a home. But 2016, this number dropped to 45%. And it turns out it's not all about brunch. In fact, it's got a lot more to do with who your parents are and the policies that have led to greater benefits for landlords rather than first home buyers. There is one policy that was introduced in 2017 that is handy to help first home buyers save. And it's called the First Home Super Saver Scheme, and involves using your superannuation fund as a vehicle to save a deposit for your first home. So what is the First Home Super Saver Scheme and how does it work? So if you're a first home buyer, you're able to withdraw a portion of any personal super contributions that you've made into your super account from the 1st of July 2017 onwards, along with the associated investment earnings to use for a deposit for your first home. So an individual can withdraw a maximum of $30,000 to put towards this major life purchase. So for Australians earning over $37,000 a year, there may also be tax advantages to saving for your first home by making personal contributions to your super. For example, a pre-tax contribution, such as a contribution made through a salary sacrifice arrangement with your employer, is taxed at 15%, which is lower than the marginal tax rate that typically apply to your wages. So withdrawals from super, which are being used to purchase a first home, are taxed at this marginal rate, less a 30% offset. This means you get to take advantage of the tax benefits of super contributions to help you save for your first home. So are you eligible? So in order to access the scheme, A, you must be a first home buyer, and both of the following must apply. So you either live in the premises that you are buying or intend to do so as soon as possible, or you intend to live in the property for at least 6 months within the first 12 months that you own it. B, you must never have held a freehold, interest in real property, a long-term lease of land in Australia, or a company title interest in land in Australia, unless the ATO determine that you've suffered financial hardship. C, you cannot previously requested a release of an amount under this scheme, so you can only use this scheme once. And D, you must be over the age of 18 when you request the release. But you can start making your super contributions at any age. Common question, what if my partner has already accessed the scheme? So good news, your eligibility is assessed individually. So this means that if your spouse doesn't meet the eligibility requirements and is purchasing the property with you, it won't prevent you from applying for the First Home Super Saver Scheme. So how does it work? So first of all, you start saving your super. So you begin by making voluntary contributions to your super account, and you can make these by salary sacrificing your pre-tax income, which you organise with your employer, or by making after-tax contributions. And in that case, you can claim the tax back on those contributions when you submit your tax return for that year. So to make these after-tax contributions, say, for example, if you're a Verve member, you go into your member login, go to the menu, personal contributions, and it's super easy to set up a one-off deposit or set up a regular weekly, fortnightly, monthly, quarterly deposit, whatever works with your cash flow. After you have spent a period saving, you then can apply for release. So when you're ready to apply for release of your super through the scheme, you have to apply through the Australian Tax Office via MyGov. And what you're asking for is a first home saver scheme determination and a first home saver scheme release. So the determination will tell you the maximum amount that can be released for you under the scheme, and it's calculated with reference to the amount of voluntary contributions that you've made to your account within the relevant time period. So you can request a determination on more than one occasion. So if you want to check in around how much you are eligible for, you can do that, and then you may decide either if you're ready to apply for a release, or you might say, no, I want to continue saving and building that up a little more. So once you've received your determination, then you can only apply for a release once. So this is really important. You should only take this step if you've made all the voluntary contributions you want to make, your determination is correct, and you've signed or ready to sign a contract to purchase or construct your first home. So you're really at that pointy edge of the process. So once the release payment has been made, you've got 12 months from the date you requested the release to sign a contract to purchase or construct your residential premises. And of course, it has to be located in Australia. So if you don't sign a contract or construct your home within the 12-month period, you can apply for an extension of 12 or up to 24 months, or you can recontribute the funds back into your super account. So it's really important to keep track of these voluntary contributions. You might do this through your own means independently. Some people are Excel whizzes. Others, you may be logging in to your super fund website and keeping an eye on it there. So then you have to provide this information to the ATO, and it's not up to your super fund to decide. The ATO will decide if the contributions are eligible for use under the scheme and what your maximum release amount is, depending on your investment earnings and taxes. So the ATO then advises your super fund the amount that can be released to you. So you can only request a withdrawal once. So as I said, this is really important earlier. You want to make really sure you're ready to request your release, because you can only do it once, and if your request is cancelled for any reason, including because you provide inaccurate information regarding the contributions, you won't be able to apply again in the future. So it's really great. Keep your record keeping, perhaps keep it independently, as well as checking in through your member statements, and make sure you get all the right info to the ATO before you apply. So for more information on this scheme, visit the ATO website. I'll put all the links in the comments below, or speak to an accountant or financial advisor. Happy saving and keep those dreams alive. I always say when you're saving for especially a home that can take a few years and you want to keep your motivation up, have it really clear on your wall. If you're a visual person, put a heap of pictures, a bit of a vision board, what you like, and the clearer you can be on what you're aiming for, the more motivated you will be and the faster you can make it happen. So happy saving, and we'll talk to you soon.